Once it has been determined that a business combination has taken place, IFRS 3 requires entities to account for that business combination by applying the acquisition method. This method has 4 distinct requirements, and it's important to remember that these 4 steps all focus on what happens at acquisition date. As revision of first year work, let's quickly run through these 4 steps. The first step is to identify the acquirer. The acquirer is the entity that obtains control of the acquiree. Step 2 is to determine the acquisition date. The acquisition date represents the date on which the acquirer obtains control of the acquiree. It is an important date because from this date, the acquiree's assets and liabilities will be added to that of the acquirer to prepare the consolidated financial statements. The third step really has 2 little sub-steps. The first part is to recognize and measure the identifiable assets and liabilities of the subsidiary. The overriding principle of IFRS 3 is that all of these assets and liabilities of the subsidiary must be measured at their acquisition date fair values, which is the topic of Chapter 7, when we will spend quite a lot of time on that. The second sub-step of Step 3 is to measure non-controlling interests. Non-controlling interests is created through the at-acquisition journal. That is the first time you measure your non-controlling interests, and that is discussed in quite a lot of detail in Chapter 3 of Introduction to Consolidations. The fourth step is to recognize and measure goodwill or gain from bargain purchase. Again, this emphasizes that IFRS 3 focuses on acquisition date because your goodwill or gain from bargain purchase is measured and recognized in the consolidated financial statements from acquisition date through the at-acquisition journal entry. You would have noticed that because I'm talking to IFRS 3, I'm using the terms acquirer and acquiree, where in IFRS 10, it uses the terms parent and subsidiary. Please note that these terms can be used interchangeably and means exactly the same. When a parent company obtains control over a subsidiary company, we have a group. Let's make it a little bit more visual. This red block now represents my group. Everything that happens inside this block, between the parent and the subsidiary company, is considered to be intragroup. And if I want to give effect to the principle we've spoken about earlier of presenting the consolidated financial statements as if it's one single economic entity, we will have to get rid of the effect of these transactions between the parent and subsidiary. Otherwise, you cannot represent this group as one single economic entity. Together with that, my parent and my subsidiary are still 2 separate legal entities. So the form of this economic event is that I have 2 separate legal entities. However, the substance of this economic event, where the parent obtains control over the subsidiary, is that I have one new single economic entity which I have to account for. This gives effect to the concept of substance over form. We've now spoken a lot about concepts and principles and single economic entity and substance over form. But how would you now prepare consolidated financial statements? How would you calculate your line items in the consolidated financial statements so that those amounts are a fair representation of this new single economic entity? Let's look at this equation in front of you. 100% P plus 100% S equals group statements. Do you think that is all it involves? Do we stop there? Would we take a line item, for instance, property, plant and equipment, and we take 100% of the property, plant and equipment of the parent, we add to that 100% of the property, plant and equipment of the subsidiary, and we add the two amounts together and we say, there we go, there's my group financial statements. Why can I add 100%? Can I add 100%? Let's think about it. What if the parent only has a 70% interest in the equity of S? Still has control, but only owns 70% of the shares, the equity of S. Can I still add 100% of the PPE of S? Or should this become 70%? What do you think? 100%? 70%? The answer is 100%. And the reason for that is because P controls 100% of the business of S. And part of the business of S is the assets of S. So that property, plant and equipment of S is controlled by the parent. So you consolidate 100% of that property, plant and equipment. You cannot control 70% of a delivery vehicle. You either control it or you don't. If you control it, you bring it in at 100% into the group. Or if you don't have control, you don't have consolidated financial statements. But the next question is, do I stop there? Let's take another line item, like revenue. Can I add 100% of the revenue of P to 100% of the revenue of S? Say that represents the group financial statements revenue if there was revenue between P and S. If S maybe sold inventories to P or vice versa. Can I then stop there? Can I say 100% P, 100% S is that of a single reporting entity? Yes or no? The answer to that is no. You can't just stop there. You can't just add 100% of the parent to 100% of the subsidiary without considering the effect of transactions between the two companies. Because the effect of transactions between the two companies would have to be eliminated through consolidation journal entries before you can conclude that the combined numbers represent that of the group as one single economic entity. So to give effect to this principle, that equation will have to change as follows to end up with fairly presented consolidated financial statements. Line by line, you will, as a starting point, take 100% of the parent's amounts plus 100% of the subsidiary amounts. The reason we're adding 100% of the subsidiary is because the parent has control over the subsidiary. But then you would have to adjust those combined numbers through your first step, 100% P plus 100% S, with the effect of your consolidation journal entries. Once you've adjusted the combined numbers of P and S with the effect of the consolidation journal entries, then you can conclude that you have group statements that is a fair representation of this economic event as if it's one single economic entity.